Listen closely because what you're about to hear is exactly how regular people get shaken out right before the market does what it always does. It tests your patience, your nerves, and whether you actually have a plan or you're just hoping. The index just printed fresh highs, and suddenly the noise machine is back. Get out now. Crash is imminent. This time is different. You've heard that soundtrack 1,000 times. Here's the problem. Most people don't lose money because they were wrong about the economy. They lose money because they react at the worst possible moment. In this video, I'm breaking down a conversation I had with a veteran macro researcher who spent years building a simple, rules-based approach for the broad US market. I'll explain the one thing most investors never do. Separate what professional traders do versus what normal people need to grow wealth without getting destroyed in the next major drawdown. Here's the big claim. Don't sell yet. Not because the market is safe, but because markets don't go from new highs to down 50% in one breath. First, they bleed. First, they crack. First, they slide 7 to 8%. And if you're following a real process, that initial slide isn't the end of your world. It's a signal telling you whether you need to step aside. That idea alone destroys panic culture because it forces you to admit something uncomfortable. Most doom headlines are early. And being early is not the same as being right. I asked him a simple question. If you had to choose one word for what markets might feel like this year, what would it be? He didn't say bullish or bearish. He said unusual. That's important because unusual doesn't mean you're guaranteed a crash. It means expect volatility, weird rotations, sudden air pockets, and fast rebounds that make both bulls and bears look foolish. The kind of year where opinions get punished and systems get rewarded. Then he laid out the framework. 2 lanes, 2 worlds. Lane 1 is for institutions, funds, desks, pros who can hedge, short, rotate sectors, and execute quickly. Lane 2 is for individuals, people with jobs, families, limited time. They don't need 17 indicators on their screen. They need a small set of rules they can follow without losing sleep. That's the theme here. The right strategy depends on who you are. If you've been watching markets lately, you've seen this pattern repeat. The first week of the year comes, the index pops, and social media explodes with confidence. People act like 5 good days prove 12 good months. But his institutional model wasn't impressed. He pointed to a short-term warning signal that triggered in mid-December based on volatility behavior. The details were technical, but the point was simple. Volatility shifted in a rare way. When that happens, you don't ignore it. For his institutional clients, that signal meant be cautious. Even consider a tactical short with a defined stop. What I liked, it wasn't emotional. It wasn't I feel like or my gut says. It was, here's the signal, here's the stop level. If it invalidates, you exit. Period. But then he pivoted. Because this is where most viewers get confused. They hear short signal and assume it means sell everything. That's not what he was saying. For individual investors, he was still saying, stay long for now. Why? Because the long-term model individuals follow isn't trying to catch every wiggle. It's designed to do 2 things well. Get in near major lows and avoid the catastrophic portion of major bear markets. He built a rules-based model starting in the late 1950s for the broad US index. Over that history, the back-tested performance showed compounded returns far above simple buy and hold. Now, backtests aren't magic. Anyone can curve fit. That's why I pressed him on methodology. He explained the index before that era was narrower, less representative. His model needed a broad, stable structure, so he anchored it from the point where the index became a true wide basket. How often does it trade? Not daily, not weekly. On average, about 1 round-trip trade every year and a quarter. You're not living on alerts. You're not glued to the news. You let the model do the heavy lifting. That's the advantage, removing the need to predict the future. Here's the ugly truth. Almost nobody predicts consistently. What you can do consistently is respond to extremes. That's the word he kept returning to. Extremes. Not normal days, not typical crossovers. Extremes. Rare events that happen at real turning points, not random Tuesdays. He showed me how he thinks about this using volatility. Count how often it moves in the same direction multiple days in a row. 2 days? Common. 3 days? Still common. 9 days in a row? That's rare. That's an outlier. And outliers matter because outliers are where crowds get trapped. His models aren't trying to call every top and bottom. They're trying to identify the small number of moments where the probability distribution changes. And when he says rare, he means rare. Some signals only occurred a handful of times in decades. Which sounds ridiculous until you realize major market bottoms are rare too. There aren't 100 life-changing lows. There are a few. I asked the practical question. If someone wanted to follow this, what do they actually do? Pick stocks, rotate sectors, trade options. His answer was almost boring, and that's what makes it powerful. He said, for individuals, don't outsmart it. Use the broad index. When the model is in, be fully invested in the broad index fund. When the model is out, step to cash equivalents like short-term bills. Binary, in or out. I know what you're thinking. That's too simple. Yes. Markets are complicated. People are emotional. The system is messy. But simplicity isn't a weakness if the rule targets the right thing. The model is designed to capture the bulk of bull markets while sidestepping the deep, soul-crushing portion of major bear markets, the part that forces people to sell near lows because they can't take it anymore. That's the retention killer in portfolios. Not volatility, but the inability to survive it. He built the model with an admission. He could model bottoms better than tops. That's honest. Most people brag about calling tops, then quietly disappear when they're wrong. His solution was straightforward. Rather than pretend to time perfect peaks, he uses a risk rule. If the market falls roughly 7 to 8% from the last relevant high after a buy regime, that's where the model steps aside and waits for the next genuine buy cluster. In other words, he's willing to give back a little to avoid giving back everything. And that's exactly what most people fail to do. They hold through small declines, then panic during large ones. At this point, I could feel the skepticism. If you're hearing about decades of outperformance, your defenses should go up. Mine did too. So I pushed. Show me the years where it mattered. He pulled up year-by-year comparisons. In strong up years, the model looked similar to the market because it's mostly invested, but in down years, the model often avoided the worst damage by stepping out early and re-entering near lows. That's the entire math of compounding. You don't need to win every year. You need to avoid the years that break you. Then he showed trade frequency by year. Some years had no trades at all. Others had 1 or 2. That's the opposite of what the finance entertainment industry wants because do nothing doesn't sell ads. Fear sells ads. Urgency sells ads. But building wealth? Wealth is boring. Here's where I'll pause and ask you a question. Do you personally prefer a hands-off, rules-based approach like this? Or do you want a more active strategy where you're constantly adjusting? Tell me in the comments because it changes what content I should make next. Let me take you under the hood without giving away the secret formula, but enough to understand the logic. His process is built from a large library of indicators, but the individual investor model only needs a subset. Think of it like this. Institutions get the full cockpit with every gauge. Individuals get the 3 dials that keep the plane in the air. The core signals look for things like unusually high volume, panic participation is elevated. New multi-month lows, indicating the market has already been pressured. Extreme breadth conditions where declining volume overwhelms advancing volume. Momentum surges that are statistically rare, like a segment making a short-term high immediately after making a multi-year low. If that last one sounds weird, Good. It should. It's not intuitive, but it's powerful because it captures something human. After a true washout, the first violent reversal is often the start of a larger trend. He showed historical examples where that rare reversal pattern appeared near major lows and was followed by strong gains before the next significant correction. Not every signal led to a decade-long bull market. Sometimes it produced a strong rally inside a broader downtrend, and the model later stepped aside again. That's okay. The goal isn't prophecy. The goal is probability. Another critical point. The model acts on the first signal. Institutions might wait for confirmation, layer in, hedge, adjust. For individuals, the system is mechanical. The first buy cluster triggers the in state, and you stay in until the system says out. No judgment calls, no, but the news says, or my friend told me. Just rules. That's why it can work, even if you're not an expert. It doesn't require you to be right about narratives. Then came the part people always misunderstand. If there's a crash coming, why not sell now? He answered with blunt logic. A deep crash doesn't begin at new highs and instantly drop 50%. It first breaks down. It first moves 7-8%. If you can tolerate that initial move because you know you have an exit rule, you avoid selling too early. Selling too early has a hidden cost. You miss upside you didn't need to miss. And missing upside isn't just annoying. It can change your entire retirement math. He used a sports analogy. Don't swing at every pitch. Wait for the fat pitch. And once you swing at the fat pitch, don't stand there wondering if the ball will vanish. Trust the probability and the rule. Now let's talk accessibility. A lot of these strategies are created for professionals, then marketed to individuals in ways that make people feel stupid. He wanted the individual version to be simple and low cost. A small monthly fee, periodic reports, and immediate alerts when a buy or sell event triggers. You live your life, check the alert, execute one trade. That's it. The institutional service is a different universe. Institutions get sector guidance, more frequent signals, more depth. The individual product is intentionally streamlined. You're not paying for a Wall Street terminal. You're paying for a traffic light. Green, you go. Red, you stop. I want to say something here that matters for trust. You should never blindly follow anyone. Not me, not a model builder, nobody. The value is in understanding the logic so you can decide whether it fits your psychology. Even the best model is useless if you can't follow it. If you're the kind of person who will panic and override signals, you'll sabotage any system. You might be thinking, okay, Alex, what should I do right now? Should I sell? Buy? Hedge? I'm not here to give you personal financial advice. I'm here to make you think like someone who survives markets. The key takeaway is this. If you're invested, have a plan for the drawdown you can tolerate. If your plan is, I'll figure it out when it drops, that's not a plan. That's a promise to panic. A 7-8% decline feels painful, but it's also information. It's the moment where you separate a normal pullback from the start of something deeper. That's why a model that says, stay in until the tape proves otherwise, can outperform the emotional investor who sells at the first scare. Most technical approaches look at common patterns, moving average crossovers, RSI thresholds, typical divergences. Those happen all the time. If you build a system around common events, you get whipsawed. His approach was different. Build around events that almost never happen, because when they do, they often correspond to structural turning points. For example, a day where upside volume overwhelms downside volume by a huge multiple doesn't happen in calm markets. It happens after panic. Or a small cap index printing a short-term high immediately after collapsing to a multi-year low. That's not normal. That's a snapback. And that's exactly what true bottoms look like. Not a gentle drift, but a violent reversal. A bottom is not a feeling of comfort. A bottom is a feeling of disbelief. I'll ask you a second question. Do you trust rules more or narratives more? Because if you're still making decisions mainly off headlines, you're not investing, you're reacting. Drop your answer below. And if you've ever had a moment where a rule saved you from a bad decision, share that too. One more layer, the model's out state. When it goes out, it doesn't short. It doesn't gamble. It parks in cash-like instruments. That's a key difference between protecting capital and trying to be a hero. Could you increase returns by shorting when the model says out? In theory, yes. He even ran that math historically, but he wasn't recommending it for most individuals because the emotional stress and volatility of being short can cause people to break the system. A system you break is worse than no system at all. For individuals, the design choice is clear. Reduce risk, preserve capital, wait for the next buy event. This is why the model can be psychologically easier than buy and hold for some people. Buy and hold asks you to endure huge drawdowns with faith. A rules-based approach asks you to endure smaller drawdowns with a plan. Let's address the biggest objection. Timing the market doesn't work. Time in the market beats timing the market. There's truth there, but it's incomplete. What people mean when they say timing doesn't work is this. Random timing doesn't work. Emotional timing doesn't work. Panic selling and FOMO buying doesn't work. But a rules-based approach is not the same as guessing. Think about it this way. If you put a seatbelt on, you're not timing car accidents. You're just acknowledging crashes exist, and you're designing your behavior so one event doesn't ruin you. That's what these exit rules are, a seatbelt. You're not predicting the crash. You're preparing for the possibility. The people who mock any form of risk management are usually the same people who disappear during real drawdowns, then come back afterward pretending they held strong. I asked him straight, what about the argument that if you get out, you might miss the best days? That's the scary statistic advisors love to use. If you miss the best 10 days, your returns collapse. He agreed. Missing the best days is lethal. But then he flipped it. Missing the worst days can be even more powerful. In major bear markets, the sharpest up days often occur near the end of the decline, in the most violent emotional period. If you can avoid the bulk of down days while still participating in rebound days, compounding changes dramatically. Picture a real scenario, because this is where retention in your portfolio is either built or destroyed. Scenario 1. You hold without a plan. The market drops 5%. You feel uneasy but do nothing. It drops 10%. Now you're checking prices constantly. It drops 20%. You start saying, I'll wait until it comes back. And somewhere between 30 and 50%, most people break. They don't break because they're weak. They break because their life isn't designed to tolerate that uncertainty. Scenario 2. You follow a rule. The market drops 5%. You notice but already know the threshold that matters. It drops 78%. Your rule says, step aside. You step aside. Maybe it rebounds. Fine, your system will get you back in. Maybe it keeps falling. Also fine, you avoided a deeper hole. The difference is psychological. A rule gives you permission to act without panic. If you've been through a tough market and learned something that made you profitable, or at least safer, share it in the comments. Your experience can help someone else not quit at the worst time. He describes signal clusters like thunder. One rumble is information, but multiple rumbles back to back tells you a storm system is right on top of you. At market lows, you get clusters of panic signals, volume spikes, breadth collapses, volatility streaks, reversal thrusts. The cluster is the fingerprint of capitulation. When you see capitulation, the question becomes, do you want to sell to the crowd or buy from the crowd? Here's a cliffhanger you need to think about. If a model like this exists, why isn't everyone using it? Because most people don't want a model. They want a story. A story where the villain is obvious, the hero is a genius, and the ending is guaranteed. A model doesn't give you that. A model gives you probabilities, rules, and patience. That's boring to the dopamine brain. Another reason. Discipline is rare. It's one thing to say you'll follow rules. It's another to follow them when your feed is screaming sell and your group chat is panicking. The crowd is loud at exactly the wrong moment. That's the moment your model is supposed to protect you from. He emphasized that out doesn't mean forever. When people hear sell, they imagine you're calling the end of the world. But the model treats out as a pause, not a prophecy. A pause is powerful because it gives you optionality, the ability to re-enter without regret. When you know you have a method for re-entry, you don't get trapped in the nightmare of, what if I sell and it rips higher? You sell only when your threshold triggers, and you re-enter only when rare buy conditions return. You don't negotiate with the market. You follow the plan. If you're one of the people doing well, whether investing, business, freelancing, share one lesson or one win in the comments. It keeps the community grounded and helps others push forward. And in the description, you've got bonus links including the premium WhatsApp channel and membership link. If you want members-only videos with extra research from our separate team, that content is built for people who want more depth. Here's the final cliffhanger. When the next real stress test hits, you're going to see everyone become a market expert overnight. They'll claim they knew it. They'll post screenshots. They'll rewrite history. And in that moment, the only thing that will protect you is whether you already decided your rules while your mind was calm. Don't wait for panic to decide your plan. Decide now. And when the market finally gives you that first crack, whether it's 7%, 8%, or something in that zone, you won't be guessing. You'll be executing. Let's make this painfully practical. If you're in, you're not dabbling. You own the broad market exposure and let it work. If you're out, you don't spiral into predictions, chase the next hot thing, or revenge trade. You park in short-term boring instruments and wait. Waiting will feel wrong because your brain is trained by social media to believe you must act every day. But remember what this system avoids, the kind of deep drawdown that turns a 5-year plan into a 15-year recovery. Here's where people slip. They want the model to comfort them daily. It won't. It will be quiet for months, then loud for one day, then quiet again. That's not a flaw. That's the whole point. If the market chops sideways and you get a quick out followed by a quick in, don't call it a failure. That's the cost of insurance. You pay a small premium in annoyance to avoid paying a huge premium in regret. The right question isn't, will it be perfect? The right question is, can I follow it when it feels uncomfortable? Because the market pays you for discomfort. It doesn't pay you for comfort. Keep that in mind the next time you see a scary headline and your finger hovers over the sell button. Your job isn't to be fearless. Your job is to be prepared. Don't confuse simple with easy. Simple is the rule set. Easy is your emotions. And your emotions will never be easy in the middle of a drawdown. That's why I keep saying, build your rules when you're calm. Write them down. Decide what you'll do at 5%, 8%, 15%. If you've never written it down, you haven't decided, you've postponed. When the next real moment hits, you're going to find out whether your plan is real. If the market rolls over, the next move isn't about being right, it's about being ready. And if the market doesn't roll over, you just protected yourself from selling into noise. That's the asymmetry most people miss. If you want me to do more content like this, breaking down strategies, highlighting what matters, calling out the noise, subscribe. It's a 1-second click that helps more than you think. Take care of yourself, and I'll see you in the next one.